A very warm welcome to each one of you and thank you for joining us today. We hope you are doing great. My name is Akshay Sisodia and it's an absolute pleasure to be your host for this exciting session. Today, India Bonds in collaboration with NISM is delighted to bring you an insightful webinar on the topic that plays a pivotal role in fixed income investing. That is decoding credit ratings of bonds. We are truly honored to have with us two distinguished speakers. First, Mr. Kapil Shrimal with over 16 years of experience in academia, currently serving as an associate professor at NISM and a recognized expert in financial education and research. Along with him, we have Mr. Vishal Goenka, co-founder of India Bonds, with over 20 years of experience across fixed income, currency, credit market, having worked with leading global investment institutions such as Deutsche Bank, Merrill Lynch, RBS, across London and Singapore. A heartfelt welcome to both of you and thank you for taking our time out to guide us today. Participants, please note the participation certificates will be issued to you in 2 to 3 working days on your registered email IDs. Without any further delay, let's dive right into the discussion. Over to you, sir.
Thank you, Akshat. Hi, this is Vishal from India Bonds. We're very happy to be doing this with NISM for the last 1.5 years now with Kapilji and myself, and very excited that more than 1,000 people registered for this. So today's topic, we'll have a lot of Q&A. The way we think is that we will cover the course for about 25 to 30 minutes. And the exciting part is the Q&A, which comes at the end. And I think few times, sir, we've answered even 100 to 200 questions, time permitting. Today's topic, table of contents, basic of bonds, just to talk to you about what is credit rating. It's very credit rating specific. So if you want to invest, to just dig a little deeper, what happens, how do credit rating agencies behave, I think this is a good session for you. Significance, rating scales, symbols, limitations. Credit rating, I say, is all it's a smell check, but not the absolute decision maker. Evolving trends and then Q&A. Let's move. Of course, this content is educational purpose only. The views expressed are personal, should not be considered as a recommendation to buy or sell. Please consult your financial advisor before making any financial decisions. From our past experiences, we've realized that there are some very basic questions that our audience asks. So we're going to put in the FAQ right up front. Corporate bonds have no lock-in period. They are tradable. You need a demat account to buy bonds. Any existing demat will do on some platforms. If you have equities, etc., you do need a demat. When you make a payment, payments from regulated online bond platforms go directly to the National Clearing House. It does not even touch the stockbroker, and who credits or transfers the bond directly to your demat account. So it's pretty safe and secure. There is no money being touched by anybody through payment gateways. Go to the clearing house. All interest payment and redemption that you gets paid directly into your bank account, which is linked when you do your KYC by the company. So if you buy an equity, the company actually pays you the dividend. When you buy a bond, you are registered as the holder of the bond in the company's records, who actually directly pay you. There is no platform or exchange who pays you interest and redemption. All interest income has 10% TDS. All the interest income is taxed at your slab rate. Any capital gains, so if you buy a bond, it goes up in price, has LTCG, long-term gains of 12.5. Most platforms, KYC is digital, zero account opening charges or brokerage, depends from platform to platform. So I hope this is clear. These are the basics, and we move on from here.
Yes, thank you, Vishalji. Now we are going to discuss about since it's a fixed income topic. So first of all, we have to discuss about what is a bond or what are basics of bond. In a layman language, bond are the instruments which are issued by the company to raise a fund. So the company generally known as a borrower. When they're taking a fund from the investors, so investors are the lender, they are the borrower, and we are giving money to the company. The face value of a bond generally it is 10,000 rupees as per the regulation of a SEBI. So minimum of the 10,000 one can invest into the bond when the primary bond market has been issued. The interest which has been paid on a bond, it can be the monthly, quarterly, half-yearly, annually, or it can be zero coupon bond also. So for a layman language, for understanding, we keep a 10%, let's take the example, 10,000 rupees of face value, 10% is the interest, that the interest is known as a coupon rate. It's a 1,000 rupees on 10,000 every year the investor will get. As per the SEBI mandate, each bond when it has been issued to the public is to be rated by the credit rating agency. So various credit agencies are there in India. We are going to discuss in the upcoming slides. Up to triple B minus is considered to be the investment graded bonds, and below that it is a non-investment graded bonds. Again, we are going to discuss in detail about what these type of ratings and bonds are there. Since the bond is an instrument which are issued, so it has a redemption value and redemption dates. So bonds will generally redeem at par, and the maturity dates are generally fixed in the market. So investors are giving money to the company will pay the interest and principal back to the investor. That is a simple bond cycle is there into the market that we can say.
Yeah, sir, just adding on, people say we do not understand bond. Believe me, bond is nothing but a loan. You give a loan to a company or the government or state government, like you give a loan to your friend or your family members. Because you are an individual and the company is big, the bond has all the terms of agreement. Because 10,000 individuals can't go to the company and say, what is the agreement? Bond, which is listed, regulated, listed on exchange, has all the agreement. So bond kuch nahi hai. Bond is just a loan to a company or
Yes.
or government.
Now, coming to the who are the various issuers into the market. So, issuers can be in broadly we can say the issuers can be the government, issuers can be the corporate. When it's the government like the state government or central governments are there. So every week central government issue the T-bills into the market. Every Monday the auctions come. So government is coming with the primary market auctions where the GSEC is a dated GSEC state issued by this central government, and state development loans are issued by the various state governments in India, and the T-bills will be issued by the central government. The nature of the T-bill is a very short term, that is less than a year, and other types of the GSECs and the SDLs are the long-term instruments, maximum up to 40 years in India. When we come to the corporate, so corporate will come under the regulation of the SEBI, under that state guaranteed bonds or the PSU bonds. So any company which is are the state guaranteed or any PSU of the state government or the central government, they will issue a bond. Any banks issue a bond comes under corporate bond. NBFCs issue a bond comes under corporate bond, or any other MNC issue a bond will come under the corporate bond. So segregated, there are two types of issuers. One is a government, and the another one is a corporate bond. So these are the two parts. Government bonds are regulated by the Reserve Bank of India, whereas the corporate bonds are regulated by the Securities and Exchange Board of India. Credit rating in the layman language. So credit rating is just like a CIBIL score of individual you and me. When we apply a loan to the bank, what bank will do first? Bank will ask us to submit our PAN number. When we'll give the PAN number to the bank will generate a CIBIL score, and based on the CIBIL score, bank will decide whether bank is going to give us a loan or not. If bank is going to give us a loan, what interest rate bank is going to offer based on the CIBIL score. So we know generally various banks are offering, if you have a CIBIL score of more than 800, you will get additional 25 basis less as compared to the other person, those who are getting at a higher rate. So these are the various parts. So just like a CIBIL score, the credit rating is like a CIBIL score of a company. When we are investing, we should know whether whatever amount I'm investing with the companies, whether it is a credit worthiness or not. Like the company will be able to pay the principal and interest back to me. So this is a simple layman language we will say about this part, and when the credit rating will be applied. So it is the alpha numerical or the alphabetically order will be there. Like we have seen AAA, AA plus, AA and AA minus and something like that. It will be there. Credit rating agencies in India are regulated by the SEBI. Some of the examples are the CRISIL, ICRA, CARE, India rating, etc. So ratings are assigned to specified instrument, not just the company. So we have to understand when one company has the 10 instrument in the market, like 10 bonds in the market, each bond can have a different rating depending upon their yield and depending upon their own due diligence, but it is not a rating of a company. So company rating might be different from the rating of the instrument available into the market. So this is a basic part of the what the credit rating is. Anything you
Yeah,
want to add?
yeah, just adding on, what sir was saying. So, sometimes company can issue a secured bond or an unsecured or a subordinated bond. So the ratings are different depending on the instrument, right? And issuer a corporate rating can be different. Everything in life has ratings, as we know. Whether you go to a restaurant, you do whatever. So it's really ratings is the best way to, as sir explained, is CIBIL score. Higher the rating, lower the interest rate. Yeah, significance of credit rating. I'll take this. So, assessment of credit risk on borrower provides information on issuer stability and is denoted by a symbol. It's very simple. AAA is the green, is the best rating, AA plus, AA minus, and there are 10 levels of investment grade rating. Uh, Government of India bonds or government securities do not have a rating. They are supposed to be risk free. They do not carry a rating. But this is how it really works. So, there are 10 levels of risk, and there are 10 levels usually of interest rates. We highly recommend for individual investors not to go in the dark red part of triple B minus. There are really, really complex credit stories, So, as the disclaimer says, bonds can default, bonds can have payment delays. So, and usually it happens on the riskier part of the curve, right? So, in equity, if you buy a small cap, it's more volatile. It can go down much rapidly, or if you buy a large cap or a mid cap. This is how to look at it: the green, the yellow, orange, and the red. You're taking more risk, and you're getting more return for that. And all rating agencies, there are a few examples, are uh, regulated by SEBI. Obviously, CRISIL, ICRA, and CARE are very old rating agencies in India. 20 to 30 years they've been around, and more stable. Some of them are owned by the global rating agencies. So this is how, very demystified, 10 rating levels. Choose what your risk is. Next slide, please. Why rating matters, right? So this is a very, very important slide. Rating is the first filter only. So for a new person saying, okay, I don't know about bonds much, or even when you're a frequent investor, if you want to build an equity portfolio, take some small cap, some large cap, and some mid cap. And hence, we encourage everyone to build a bond portfolio and buy different bonds, not only one bond. But this is a first smell check or first filter. See, where am I on the safety? Okay. Hence, sessions like this where we think understanding of people is still lesser to help you. Every public issue bond or NCD has to have a rating. And every public issue and listed bond. So एक जरा मैं difference बताऊंगा. Please only buy listed bonds. Listed bonds are listed on the exchange and regulated by SEBI. Obviously, buy from platforms that are regulated by SEBI. In early years, 21, 22, we saw a lot of platforms selling fixed income type instruments which are not regulated. We've had a lot of accidents and invoice discounting and things which are not regulated. Any regulated platform can only show listed bond, and all listed bonds have to have a rating. So you see, if you buy a listed bond, you have so many layers of protection. You buy from a platform which is SEBI regulated. You buy a bond where, because it's listed, they have to do financial disclosure. Okay. And it has to have a credit rating. So it's a third party who's evaluating the credit. So hence, I think you should always buy only listed bonds. This is SEBI definitions of rating scale and symbols. AAA, highest degree of safety, lowest risk. AA plus, AA minus, very high safety and marginal risk, and so on and so on. You can see triple B plus, triple B minus says moderate risk. I think for retail, this is also very high risk. Triple B and triple B minus, it is not moderate risk. This is devised more as an institutional benchmark. Double B onwards is highly discouraged for, obviously, individuals to buy unless you are a very, very credit professional and you can work like a large credit institution. Just to get 1.5%, we will discourage you to go to the riskiest part of the segment. But these are available on the SEBI website also. This is what they mean in the English language. Next slide, please.
So here the credit rating rationale. So how this credit rating has been decided? What is the rationale behind the providing the rating to the any of the company or any of the bond by the rating agencies? So credit rating rationale is an official note published by the credit rating agency explaining why the specific rating or outlook that assigned to the company on a bond. So what are the criteria, how they have done the due diligence, what are the parameters that rating agency has considered to provide the rating of that particular company, it has been come. So what are the key components of this particular rating rationale? Number one is rating action and outlook. So what is the rating rationale? For example, it is a CARE AA minus or a stable rating. So this is the outlook and the action of the particular rating agency of that particular instrument. What are the drivers, the strength, what is the strength of a company, what is the risk involved in an instrument, what are the financial indicators influencing the rating. So suddenly rating is might change. So due to what, if the profitability is not there or company is suffering from some financial losses, it can be there. The analytical approach, so standalone or supported, for example, it is a guaranteed bond or it is a CE bond. So so that is based on the approach of a company and the rating sensitivities. So it's a trigger upon upgrade or downgrade. So how it if the let's take the example AA minus upgraded to AA plus, so it is upgraded, or the AA plus degraded or downgraded to AA minus is the downgrading of that particular. So how sensitive that particular bond is. Why it matters? So it is a mandate by the SEBI for all the public debt issue, enables investor to understand the rationale behind the credit score and acts as a quickly due diligence for the tool of the risk assessment. So because we know when we are investing into this type of instrument, so first of all, we have to do the due diligence. We cannot blindly invest in the fixed income instrument without knowing the rating. So it is a due diligence process, and as per SEBI mandate, the company has to disclose the credit rating rationale. So these rationales are given by the credit rating agencies. And the rating shows the level of risk. So rationales explain the reason behind it. So which type of level of risk, if it is a high level, low levels, are different investors have different risk appetite also. If you have the low risk appetite, you should go with the high rated bond in spite of the low rated bond into the market. Yes.
Just one thing I'll highlight, sir. The
Yes.
outlook is important. Outlook is positive, stable, or negative usually. So if you are buying a bond and someone is telling you it's AA minus negative outlook, which means most likely it'll get downgraded. So avoid that. If it's a positive outlook, that's good because within the rating also they have slight notches.
Yes. Yes. Next, please. Now the rating evaluation framework, how the evaluation of this rating is done. So how the ratings are determined. So different the criteria are very different, but yes, there are the three basic parameters that we can come. So first, the quantitative measure. So it will come what are the leverage ratio of a company, what are the coverage, interest coverage ratio of a company, how the cash flow adequacy of a company, was the debt structure in the entire capital structure of a company. This is a quantitative measure. Number two will come with the qualitative measure. So what is the strength and weakness of the management? What is the business model of a company? Which sector, or is there a sector risk is involved or not? Or ESG profile of a company is also measured nowadays as a part of the qualitative measure. And external measures, so it will macroeconomical factors, so economical trend, regulatory framework, how the regulations are there towards the sector or the company, and how the market is volatile. So combinedly, all these three, qualitative, quantitative, and the external factor, the rating will be allocated by the rating agency. And each rating is finalized by the rating committee, not an individual analyst will do. So one committee has been formed by the rating agency, and to maintain independence and the consistency, it will be what we can say, it will be follow up or the review of this rating has been done frequently basis to provide the more transparency to the investors. So qualitative, quantitative, and external factors that has been considered by determining the ratings that we can see. So yes, so from mandate to monitoring, so how the rating cycle will be there. So rating process and the surveillance is required. So there must be some cycle. So issuers mandates, CRA credit rating agencies. So one mandate, the issuer mandate is there. They have to approach the credit rating agencies. CRA conducts a data review and management meeting. So once the rating agency has been done, then it will be do the review of the data. Okay. And the management meetings has been done with the management. Drafting rating assigned, rating committee approval. So whatever the rating has been done, the drafting of the rating will be done. It will be going to the committee for the approval. Rating published on the credit rating websites and the stock exchanges. So what after the approval of the committee, it will be published on the exchanges and the websites of the credit rating agencies. Continuous surveillance every 6 to 12 months, and upon on the material events such as the good thumb rule. Not it is not mandatory, but yes, whatever the events are there, every 6 months to 1 year, the company or the rating agency has to monitor the rating and review it. And further, it can be given the disclosure that if the rating is be same, or it is going to upgrade it, or it is going to be downgraded, depending upon any event or any action has been taken by the regulatory body, the rating can be changed also over the period of time. So this is a very cycle which will continue go into the market, that we can say. Anything you want to add, Vishalji, over here in this part?
No, the importance of this slide is, people are asking questions. What are the checks and balances? And some good questions coming. I will advise people to type on the Q&A. There's a Q&A tab. If you type on that, it's very good for us to know. We will answer all those questions after this. But you have to understand there's a whole ecosystem of regulation. And, these companies function like companies, right? So they have a committee, they have a management, they have surveillance. Things could go wrong. But there has been in the past that SEBI has banned a rating agency for 6 months and things like that. So it's important to know that there is a system and check in place when these things are done. Yeah. No, they are not government controlled. They are private entities, but regulated by.
So now, what are the scope and the limitations of the credit rating? So when something will come, yes, it will come with this particular described scope by the regulator, and what are the various limitations. So what rating indicates and what it does not, they don't indicate. So indicate the risk, that is the credit risk, that is probability of a timely payment. So when the rating has been done, what is the credit risk is there? We are going to discuss about the risk of investing in instrument, yes. But if it is a risk is there, so we'll just consider our CIBIL score. Let's take the example. If I'm going to take a loan from a bank, and bank will see my CIBIL score is 800 plus based on the past performance of the payment of a loan, the risk is lowest compared to default. But at the same point of time in this CIBIL score, it has been mentioned that I've not paid 2 to 3 EMIs, have settled one credit card, the CIBIL score is go down. So risk is associated. The interest rate offered by the bank will be higher as compared to the higher 800 plus CIBIL score. That part is there. So credit risk is, they are going to indicate the credit risk, especially whether creditability is repayment of the payment will be not or not. Then they do not measure the price movement, market liquidity, or the interest rate risk. So credit risk is purely based on the credit default or credit risk. It is not about the interest rate risk or market liquidity. Market liquidity, interest rate risk comes under the macroeconomical factor. It is not related to the company factor. Investors must look beyond the rating, like analyze what we can say. They analyze the conveyance, the 10 years issuer fundamental. So as an investor, when I investing into this part, so what are the fundamental of the company? What is the maturity date of a company? What are the convenient dates? Whether it is going to give me the coupon frequently? What is the frequency of a coupon? Which each parameter as an investor I should also see beyond the ratings. It might be possible rating can be high, but at some point of time, we can see the highly rated instruments like the ILFS Divan Housing Finance Limited are the two best examples in India. It was AAA rated once a time and suddenly downgraded post default, and highlight the time frames rating has been key. So we have to understand highly rated should not be always a good part. It can be considered the other variables also before investing into the instrument.
So I will, sir, just add on to that it has also happened in the US and all other worlds. But since, ILFS DHFL was 5, 6 years ago, a lot has been done in the country for disclosure, for retail investor and investor protection. One question I'm seeing a lot of people are asking that how will I know if a rating changes? So, again, part of the new regulation or the part of the effort to build infrastructure, there's something called debenture trustee. Debenture trustee is again regulated by SEBI. Remember, I told you the bond is an agreement. It is debenture trustee's outlook to make sure that everything the issuer said on that bond is followed. So if there's a rating change, the debenture trustee who also has your details as a holder will immediately email you. We've seen very, very often if suppose there is a rating change, there is a payment delay. Debenture trustees are very active, very reliable, regulated by SEBI, and very fearful that they make sure that the investors are informed in time. These things did not exist 3 years ago, 3 to 4 years ago. So a lot of good stuff has been done talking about.
Yes, I think implications.
Acha, sir, it's for me. Okay. Yeah. So, rating watch outlook and downgrades. We spoke about it. Outlook, positive, stable, or negative. These are good signals. Avoid credit rating, like let the downgrade happen. So, it could be a double A plus saying it's on negative and goes to double A, which does not mean it's a bad credit. It's not going to default. It's just that it's going to give you a higher interest rate. Rating watch hota hai jab when there is an event. A company announces a merger or a takeover. The credit rating agencies put on rating watch, saying, let us see what the outcome is, what is happening. And after everything settled down, we will analyze the balance sheet and tell you what the rating watch is. Importantly, and this is something in covenants to note, covenants are the rules when the issuer writes a bond, says ki, I will follow these rules. And there is a question we will answer later. People have asked what to look out for. So just make sure, these things help you as an investor. If if the issuer says, if I have a rating downgrade, I will give you more interest, which means the issuer is aligned to you, right? So these things help and make it more hard on the issuer to do defaults, right? So covenant breaches, margin calls, uh, below triple B minus is what we call non-investment grade rating. Do not go there. An example is given when rating downgrades by one grade, the coupon will increase. So people are compensated. कि भाई मैंने खरीदा था as a double A bond, it's become a single A. It's not necessarily going to default. Its rating has changed, but you want a higher payout for a little more risky bond. That's what the rating trigger helps to protect the investor. Please ask and look. So regulatory and market framework, we spoke about this, is governed by SEBI, all the rating agencies. Mandatory disclosures and exchange filings have to be done. Obviously, to learn about NISM, SEBI promote investor literacy. And CRS, the rating agencies started publishing annual default rates and things like that. For example, there's been 0% rating default in the country in the last 5 years. I think double A is like 1.5%. Just to put in context, in the large economy like US, rating defaults are 3 to 5%. It's a much more aware economy. People are very aware of the risk they take, and they have a high default ratio. Their market is $40 trillion. Our market is $2.8 trillion, but they have 2 to 3% default rate, which is even higher than in India. This is a very important slide. It's going to help you how to think about risk and return. So here we have divided from current market yields as to what your returns are. So government, beyond rating, it's risk free. Government bonds give you 6.5 to 7%. Obviously, if you do 1 year treasury bill, sub treasury is a 5.75, 6%. But on the upside, if you go for like a 15, 20-year bond, annualized, it's giving you 7%. Obviously, there's an RBI policy in 2 weeks, and these rates get the most impacted by RBI policy. If you go to AAA, it's moderate, low to moderate risk, 7 to 8%. Some names have been highlighted. You go to AA, you get a little higher rate. You go to single A, you could go 10 to 12%. Triple B, please be careful. At least triple B and triple B minus, triple B plus still is okay. It should be above 12% or closer to 12 or above. Triple B minus, it's not advisable. Institutions do triple B minus trades at 15%. I don't know why, some bond offers are there. We as a platform do not show any triple B minus, but some platforms do offer. Be very, very careful. Why rating upgrades? Or, there's some rationale for students who want to understand this. You can take a snapshot. This presentation is not going to be shared unless it's available on, I think probably on YouTube, NISM and India Bonds YouTube. These are the factors which decide for upgrade. Stronger financials, leverage has reduced. Leverage ratio is the most important thing to look for any bond. Some people ask after credit rating, what should I look for? Leverage means how much debt versus your equity you have. Obviously, if you owe people a lot of money and yes, you're a riskier business, right? So leverage ratio, 2x, 3x, 5x is very, very important, and covenant around that. Usually there's a covenant that your debt or to equity means the money you have borrowed to the money you've put yourself is not going to breach a certain ratio. Obviously, check the promoter and support group, right? So, who are the promoters? Do a little research on them. What is the history? If liquidity has improved, if the industry has improved, right? So, let's say the government says, I'm going to have massive discounts for renewables. So, that whole industry improves, right? Financials. So, that impacts the industry and the track record of timely debt servicing. Next slide. Rating downgrade, simple. Financials are deteriorating, leverage is going up. So keep an eye on quarter to quarter report. Negative industry outlook, corporate governance issues, very, very important because these bonds are listed. If there is a case or a corporate governance issue, they have to disclose to the exchange. Hence, only by listed bonds, so you know what's happening. Withdrawal of support, change of control. Somebody else owns the company now. That's a flag. Let's go next. Sir, this is me or you? I don't.
Okay.
मैं कर ले हाँ कर ले
Okay.
Every bond ISIN is a unique identifier of a bond, has its last rating and symbol. Rating fees are paid by the issuer. So issuer decides who's my rating agency. Hence, you have all these checks and balances because if the issuer is paying, can they try and manipulate or not? Unrated bonds cannot be sold to public, like in retail online bond platform. You can still go and ask your broker if you're that excited. Uh, and they have to, the rating agencies have to talk about conflict of interest. Next one, please.
Yes, so now coming of the what are trends and emerging practices into the Indian bond market, especially. So there is significant rise of the ESG and green bond rating. So we can see lots of the municipal parties and the corporations or even the companies are coming with the ESG bonds, a new the circular from the SEBI also, which has been released 2 months before on the ESG bonds and sustainability bond in India. So now these bonds are coming into the market and the ratings are increasing in this type of bond. The segment like the REITs, InvITs, municipal bonds, expanding coverage, like rating coverage. So we can say there are the REITs are also issuing into the market, InvITs are issuing in the market, municipal parties are coming with the bond, and they're expanding on the rating coverage. So the rating agencies are also rating these instruments, which will have an idea for the future trend of the market. Increasing use of AI-based early warning systems, so we know how to identify using the AI tool like the some of the programming language, machine language, LLM models or something like that, to do the fraud detection, to do the default detection, to do the credit analytics. These all tools are available. So if you are investing to the bond market and if you are able to do the programming using this model, you'll able to know whether the bond is going to be default based on the financials of a company or not. And retail bond platforms like the India bonds or other OPV will displays the live credit metrics to you. Even the live credit metrics that are available publicly, so you can see this metrics as to know whether in the future the bond is going to default or the company will be stable into the market. As SEBI recently allowed the multiple rating agencies for large issue of enhance transparency and reduce the rating biases. So we can see, so nowadays some companies are coming the multiple rating agencies also. So one or two or more it will be there. So it will give the more transparency to the individual, and this rating will be not biased. So if some rating agency is giving you AAA plus, for example, at the same point of time, AAA one company rating agency is giving AAA, and at the same point of time, another company is giving AA. So there is a rationale of some rating points, and they have to come with the disclosure why they are giving a difference of the rating. So that part will be give more faith of investors to the before investing in the market. So these are the trends which has been coming into the market over the period of time. So before you invest, what are the checklists that you have to do as an investor? Always check the credit agency name. So what are the name of the agency? What are the rating symbols are there when that has been issued, and what is the rationale behind that rating? So I hope Vishalji, we are going to show, for example, from a platform also how to check the rating rationale if it is possible of
हाँ
any
सर,
bond. They'll able to
थोड़ा सा
know
हम दिखा देंगे,
what
but
is
yeah,
rationale will be
yeah.
there. So if you are investing into the bond, you'll able to know what are the rationale. Number two, track rating
Let's
check.
move on. Let's
Yes,
try and finish
post
this now.
issue and they affect the bond. So after issue, how the rating has been changes. So recently, some examples are also there into the market. So after the issue, rating agencies reduce the ratings. So this is one of the another checkpoint is there. Then prefer the bond with a stable outlook. That Vishalji at the initial slide he has been discussed that if it is a negative, so it can be chances to go down in future rating. But if it's stable and positive, yes, it will be stable and it can go up, upgrade it can be there. And rating is equal to risk signal, not a guarantee. That is an important
Yes.
part. So investment in market is subject to market risk is always there. That disclaimer should be there. So when you're investing, whatever rating is there, it is an opinion, it is a signal. It is not a guarantee that it will be stable over the period of time. So retail investors can view all the current bond rating on the credit rating agency website and the stock exchanges listed on the NSE and BSE. Anything you want to add on this?
No, sir, I think we'll move quickly to the Q&A. A few
Yes,
slides. We'll go
Q&A.
through our
We
last
have the
few
less
slides.
time.
Yeah. Yeah.
Next slide, please. So it's on you.
Yeah, so one thing, this is just an example. Credit ratings are available on all regulated bond platforms and apps. This is just a snapshot of India bonds where you can actually go to the bond detail page and look at your credit rating and rationale. This is compulsory, mandatory for all regulated online bond platforms. So you have to know and you can read it yourself. This is just a tool. I think there was a question Sir, can I get upfront? What are the covenants? Why do I have to read? So, actually, we've introduced something called India Bonds AI, where actually the 100-page memo, you can ask questions to it. What are the covenants? What is the rating history? So, technology is disrupting everything, right? So, information should not be held or privy to a certain people, right? Today, we use Chat GPT or whatever to ask anything, and the answer comes in seconds. Our effort is to introduce that to make it easy for investors. Next slide, please.
So here comes the risk. So when we
Yeah.
are investing into the instrument, whether it's a bond or equity, some risk is there, especially into the fixed income security market. Number one risk is the liquidity. If it is a low rated bond or you invested into the bond which are not listed on exchange, the liquidity risk is the most prominent risk. If you are buying a bond from the platforms which are not regulated by the SEBI, it can be the fraud risk. So recently, if I'm not wrong, SEBI has come with a circular also on the online bond providing platforms and some of the digital platforms, those who are selling the bonds online, but they are not regulated. So fraud risk can be there. Market risk is there always into the bond market. If the interest rate will go up, the valuation of the bond will go down, and interest rate will go down, the valuation of the bond will go up, depending upon the market cycle. So there is market risk. And yes, credit risk is there. So today, entire presentation is on the credit risk that you've seen. So is the creditability will be there, whether the fundamentals of a company is good or not, whether the qualitative, quantitative measures of a company are good or not. If something changes, the rating will go down and it will affect the pricing of the bond. So with this, I think we are going on the Q&A, if I'm not wrong.
Yes, we'll go on the Q. The important point of key risk, I know we all know that, but we really want to tell you nothing is risk free. Every financial instrument you do has some risk. I think in the past people thought bond hai to 100% nahi. You please read the disclaimer, do your own study. But yeah, you can make higher returns, or depending on your risk appetite, you can choose your returns. Yes, can you stop screen share and we go to Q&A? All right, sir. We have about 50 questions. We'll try and run. This is, we do rapid fire answers. So to keep you engaged, will a certificate be given for the webinar, yes, sir?
So that
And
has been given in the initial part only.
yeah,
2 to 3 days it will be there.
how long time does it take to change credit rating? Question to you, sir.
So how long time? I think we have mentioned in the PPT also, so it will be frequently monitored every 6 month to 1 year cycle can be there. And
Or there
whenever
is an event. Yeah, or
yeah,
there is an event.
is
Yeah,
there
if the
any
company
event,
has
there
a
is a
news or
fault is there.
something. Yeah, yeah.
So it can be done, but frequently check has been done by the rating agency.
Uh, Okay, I'll answer this. Some portals offer transfer immediately, while some portals take T+2. Portals like India Bonds do. Sir, it's about technology and different business models. There is facilitation to, do a T0. It's better than equity. For example, on our platform, you can buy at 3 o'clock and you'll be in your security account at 6 o'clock that evening. That all exists thanks to, clearing houses, NSC, BSC, who have taken the technology in our country is very amazing and made these infrastructure possible for everybody. Uh, why many time bond price become higher or lower than face value, sir?
So the simple example is that it's totally depending upon the yield of a bond. The simple will say if the coupon rate is lower than the yield of a bond in that point of time, the bond is always traded discount to the face value. If coupon rate is higher than the yield of a bond, it will be traded a premium, and if both are equal, it will traded the par. So it totally based on the interest rate. If the interest rate will be favorable, then we'll say the price of the bond will go up, interest rate goes down, and vice versa will be there.
Yeah. How do we know bond is listed or not? As we said, every regulated platform can only show listed bonds. So including us or whoever else. So you have to make sure you understand that. There is also a bond directory that NSDL has or India Bonds has. You can go and check before you invest on any platform. You can go on that directory and check whether listed or not. Uh, do fixed deposit scheme provided by government has credit rating? Madam, I did not understand this question because government does not have rating. But I'm not sure of
Government
fixed.
does not issue the fixed deposit also.
Yeah, so I don't understand the question. Fixed deposits are issued by banks. There is an issuer rating and some NBFCs. Um, This is a very good question. Someone said, since low rating carries high interest are avoidable for retail, maybe retail should be given some incentive. Very good question. SEBI only last week introduced a discussion paper. What we like about SEBI is SEBI usually puts a discussion open in the thing for participants to give feedback and then comes up with a regulation. उसमें ये proposal है, there's proposed that for public issues, maybe retail investors should get a higher interest rate than non-retail investors. I think the regulator is working because I know from fresh last week this paper was issued. So let's wait and see. Which agency rating is reliable, sir? We can't. If rating agency exists, they're allowed to exist. We highlighted there are three very old rating agencies. How do I know the company is good except the rating? I think we've answered, but Kapilji, you want to address it again?
Uh, so I'm not getting the question. How do I know?
How do I know if the company is good except rating? Matlab, you have to study those metrics, right? So,
You have to study the metrics. So again, company rating can be individual company to company perspective, but you have to understand the fundamental of a company. And again, the fed towards the market. So you have to see on that part also. The rating can only one measure to understand, but other factors also do.
one question, will rating downgrade as soon as single default of coupon also occurs? Now, here the question, there are two different things. If a delay in the coupon exists, there are usually provisions that in 5 days the coupon will be paid, 10 days. Obviously, the flag goes up. कि भाई कुछ गड़बड़ है, there's something wrong. Default means downgraded, right? So default is a very different thing, meaning than delay. If your question is if coupon is delay, no, rating downgrade is not automatic. Sometimes there are technical difficulties. Sometimes companies are raising equity financing, got a little delayed. So, but default in a coupon in a technical terms, when it's announced as a default, will straight away go to D. What difference between subordinated and unsecured bond? They could be unsecured senior and subordinated by nature are unsecured, right? So I think that's really the difference.
But some point of time, I think banks generally issue the subordinate debts only into the market.
Yeah, sometimes we see, sir, NBFCs also, right? So small
Yes.
finance banks and banks issue subordinated.
Subordinate debts.
A lot of people, we've answered the questions. Why is there no standardization of rating across rating? No, there is standardization, right? You have these 10 categories that you have to rate. Some call it AAA, some call it AA plus, and someone will call it AA1, AA2, AA3. Just the methodology is different, but there are only standardized 10 categories of investment grade ratings. Why does SEBI approve the launch of listing of bonds with triple B minus or below for retail? I'm not the right person to talk about it. I'm not aware of it. Uh, uh, why they allow? I mean, people have all kinds of risk metrics, but I think we will skip. How much does risk in percentage increase if a company goes from A plus to A? You can answer or I can answer, sir.
So you can answer this question.
So I see it's not set in stone, right? Because I showed you the risk metrics where between A plus and A, you can have rates of 10 to 12%. But in A plus to A depends on the sector and the company. But yeah, at least should be 50 basis to 100 basis points is my assumption. But it is really specific to the company. Even after AA bonds default, how to identify at the earliest? I've not recently come across AA bonds defaulting, at least in the last 2, 3 years in the country. We remember 2021 and 19. So difficult for me to answer. But usually a AA will not go to default straight away. AA will have a negative rating watch, go to A plus, and then nowadays it will kind of go down slowly. So you can, move out of that bond. If there is a change of rating, can individual redeem the bond? Very good question. If it is in the covenant, so we've seen this in the past 2 years. Some NBFC says if a rating changes, you can call for your money back. Very few NBFCs I've seen, but yeah, you have to read it in the covenant. Not every bond has it. It's very specific, small. But I have seen this example: rating change, redeem the bond. What is difference between bonds and convertible loan notes? I'm not sure what convertible loan notes are, sir. Have you, Kapilji, do you know? I mean, there are bonds and convertible bonds.
Convertible. NCDs,
You know,
convertible debentures are
yeah.
there.
Bonds and NCDs means the same, convertible debenture. Non-convertible debenture and bonds. Convertible debentures are that after 5 years or something, you own the equity of the company, some of the equity through a formula. What is the breach of covenant? What does it mean? Sir, you want to?
So what is the breach of?
What does breach of covenant mean? Yeah.
Sir.
So breach of covenant. So covenant are rules, right? So issuer says, if my rating downgrade happens, this happens. I will not take on more debt. oh, in NBFC you have, a non-performing asset, that my level of NPA will not go high. So if the issuer breaches that, that's called a breach of the regulate or rule or covenant, which he had determined at the issue of the bond. Debenture trustee will tell you immediately. He'll email you and say there's a breach. Where to watch all these rules and outlooks for a bond? Very simple. On any platform, bond directory. On our platform, you can watch all the ratings. Have to tell you what's the outlook. As we showed you, it has a rating report rational which you can download and read. Which is better, double A or double B plus? I hope you were watching our presentation. Double A is better. Double B plus is hardly discouraged for retail. So non-investment grade or low rated are not open to retail. Of course, it is open to retail. I mean, if you decide to do something, you can. It is entirely up to you. You can call a broker and see where it is available. They are usually, I have not seen them available on regulated bond platforms. So this we can answer. Sometimes a bond also offers coupon of 11, but YTM is 13, yield to maturity. Why is that the case? If you can explain, I think it's the. So firstly, yield matlab returns hota hai, just in simple English. So let's not get confused. Yield to maturity means returns to maturity. But Kapilji, if you want to answer, 11% coupon, why is it 13% YTM?
So yes, so yield is nothing but the what we can say total return. So what it means, whatever coupon you're receiving, the coupon you are reinvesting at same market rate. So for example, you purchase that bond at 990 rupees and bond is going to mature at 1000 rupees. So there is a capital gain of 10 rupees. A part of this capital gain of 10 rupees, there is some coupon that has been received. So you're reinvesting that coupon. So yield is a total return of the bond, including the capital gain, and the reinvestment part is there, and coupon will be fixed over the period of time. So coupon can be lesser than the yield. Coupon can be higher than the yield depending upon the nature of an instrument, that we can say. If bond is available at premium, in that case, the yield will be lesser than the coupon.
Yeah, if bond is available at a discount, which means the returns you're getting is more than 11%, right? So that's why it's yield. Do you have a tool to calculate effective YTM? I don't know about others, but at India bonds, you have a bond calculator which you can calculate. Uh, when will sell transparently happen in bonds? So, very good question. Unlike equity where you can say buy or sell, in bonds, all the bonds you cannot see buy or sell. Also, what we are working with clearing houses is selling a bond sometimes is a pain. You need a DI slip and things like that, some paperwork. I think very soon technology is coming, whereby if you click a sell, you'll be able to sell and no forms to be filled, physical forms, and you can do it online. I think that's when the liquidity will really. One person said, I've seen different prices on different platforms. How? I think it's the same as anything in life. You can go and buy a bicycle and there'll be different prices of the same brand sometimes. It depends on the model of the business. Even tomatoes have different prices. Everything has different prices sometimes. And it really depends on the business model. Cheaper pricing means the platform is more efficient or sourced it better. But yeah, it's like anything. There's nothing written in stone here. One question, yeah, you say government bonds are very secured, offer 6 to 7%. How come some state guaranteed paper offer 9%? So very good question. Now, state guaranteed means it's a company owned by a state government, which has a different credit rating. Okay, so SDL, state development loans, are guaranteed or, not explicit, but by the central government or GOI. But state guaranteed paper difference is that it's a company on a standalone basis. It gets a rating. Typically, in the rating, you'll see double A or something in bracket CE, which means there is an implicit support by the state, right? In India, no state has default as such, and that's why you get a higher. You're taking a higher risk and you get a higher return for that. Very good, sir. Questions are very interesting. Yeah. Will a company have the same credit rating when it is done by multiple credit rating agencies?
Again, it depends.
Yeah,
So
it depends. It's not necessary.
it's
Yeah.
not necessary. It depends. It can be the prospects of a credit rating agency, but plus minus can be there. Generally, it can depend on rating agency.
Good question. Where to get list of regulated platforms? Very easy. Just Google search. It's on SEBI website. Just do SEBI OBPP online bond platform list. You will find the list out there. So before you buy from any platform, do the check. Please highlight 15G and H form. 15GH is when you tell the issuer not to deduct tax TDS on your interest coupon. Either your income is lower than taxation rate or you're a senior citizen. You can actually fill this form. You have to send it to the issuer because only issuer can decide, is the guy who pays you, is the person who pays you. I don't know about others, but on our platform, when you buy something, in your order book, it'll show generate 15G form if you're eligible. We help you to give you the details of the company as to who to send to. There are questions about our platform, Mr. Goyal. Happy to answer through your RM or send us a contact us. Will a bond pre-close before the maturity? No, it will not. I know some people say redeem my bond before maturity. It is not redemption. You are selling the bond. Whoever is telling you redeem the bond is technically incorrect. A bond has a final maturity. Maybe they will buy from you at the market prices. There's nothing called pre-close or redemption of a bond before maturity.
If the bonds are callable, in that case, it can be there.
Yes. So that's the next question. Callable means, if there is a bond for 5 years and say, hey, in 3 years, the investor can take his money back, which is called callable, then you can do before. Oh, good. We answered. State guarantee question is coming. When a bond is AAA or AA, should it still be secured?
So that answer we have given in the presentation only.
See, usually AAA unsecured bonds are issued by large public sector companies. Let's say I'm just going to take a name hypothetical. Let's say a Tata or a Power Finance Corporation will say, everybody knows me. I'm such a big balance sheet. I don't need to secure my bond. I can do unsecured. Okay. AA onwards, yeah, people need security. Highly unavoidable to buy unsecured bond, unsecured senior bond, very highly unavoidable. What does secured means? If something goes wrong, you have some assets that you can recover some money. Unsecured means you're way lower in the redemption cycle. How to recover money if the company collapses, default? Very good question again. If there is a default in the company, actually, the debenture trustee will get to you. So, firstly, everyone should remember that buying on a regulated platform is just a facilitator unless they say we have done the due diligence, then you should go after them. But it's like buying an equity through a stockbroker, right? If the stock goes down, if the biggest, you don't call your broker and say, why is the stock down? You sold me the stock. So, be careful. Even with bonds, things can go wrong. Debenture trustee usually collects all the bondholders. There is something called Indian Bankruptcy Code, which is an NCLT code. It's outside the regular code, where debenture trustee then appoints a representative on that. It takes some time. It can take 6 months, 1 year, sometimes 2 years. But the bondholders come together as a team and then go for recovery from the asset. Sometimes that company is then sold to somebody else and they can pay. Okay, well, someone is asking for a view. I can give my personal view. What is their view on securitized product market and trends? Is it going to explode? Sir, you want to attempt or should I attempt? Whichever way.
You can give the answer that way.
I think securitized products is good for creating liquidity for financial companies. It is good for investors who are sophisticated investors. Let me remind you that. So, large bank treasuries, asset managers, sophisticated credit investors. I am not a big fan of retail investors buying securitized debt instruments because it is a pool of loans or pool of receivables which you think is diversified, but actually, I don't think most retail are equipped to analyze the pool. I can have 1 lakh loans. Out of 1 lakh, 5,000 will be the lowest grade loans. Anything, you have a large collection, you can grade them, right? What if I put those 5,000 loans in the pool, right? So I'm not a big fan. Pehle, like the problem we have in our country is people have to understand bonds and then get for securitized. It's a great product for sophisticated and institutional investors. It's my personal view. I think we're coming to the end. Sir, आपके लिए तो है. Difference between direct bond investing and debt mutual fund.
Yes, so direct bond investing, debt mutual fund. So debt mutual fund is again a portfolio they create for the by investing various bonds or the NCDs. But the part is that when they create a portfolio, they'll take the expense ratio from you. But if you're good into the analytics and you know which bond should be invest directly, So you can save that expense ratio and the liquidity can be provided to you. That is one part. Part number two, when you are just like equity, direct equity investing and the investing in the equity mutual fund, it will be same point of time can be there. So let's take the example, if you are investing into the liquid mutual fund, that considered to be debt mutual fund. Okay, when liquid mutual fund is going to provide you whatever the return as a point of, let's say, between 4 to 5% at same point of time. For the liquid mutual fund are investing into T-bills, you can invest directly into T-bills also. You'll get higher yield as compared to the liquid mutual fund. That will always, you're going to save some expenses ratio if you know the analytics and you know which bond to be select.
So one good question, that why do debt mutual funds give lower returns than individual bonds? See, debt mutual funds are very important for our industry also. They give you the facility of quick exit, right? NAV exit. They obviously have costs attached, maintaining professional fees, etc. That's why the returns are lower. So you get higher return in direct bonds, but you're taking a little higher risk also, right? So just remember that it depends on what you want to do, right? So within your fixed income portfolio, you can have a place for both, really. Okay, now we are coming. There are three more questions. 182-day T-bill has 5.5 yield. Does it mean 5.5% is my return for 182 days, sir?
Yes, yield means a return.
Yeah, it is the annualized return, just to be clear.
Annualized return.
Yeah, if you put 100 rupees and you get 105.5, no, you will not get 105.5, you'll get 2.75. So it is annualized returns. For 6 months, you are
So when
making
you see the issue price of that T-bill, it will always issue a discount to you and mature at par. So whatever the return is there, it will be generally adjusted at the time of the issue price. So generally the T-bills are issued at discount to you and mature at par.
Yeah. So one question is again coming, how will I know if ratings have changed? I'll repeat, debenture trustee will email you when ratings have changed. There's one interesting feature we are bringing on our platform in a month's time is about if you have a bond issue, or you will get the news of that on the app itself, right? So much like equity markets, we think people in the bond market should be more aware to use technology to do more things. I think, sir, that brings us to the end. We have tried to answer close to 100 questions, and we are still doing good time. Akshat, back to you.
Yes. Thank you so much, Dr. Kapil and Mr. Goenka, for such an insightful and engaging session. Personally, I had so much to take away from this session, and I feel the audiences resonate with me. And a big thank you to our wonderful audience. Your energy and thoughtful questions made this discussion truly meaningful. To keep enjoying such sessions, make sure you follow India Bonds and NISM YouTube channel. Once again, thank you so much for the participation. Certificates for this will be sent to your registered email ID within 2 to 3 working days. Have a great day, everyone. Cheers.
Yeah, thank you. Thank you, Kapilji, for being here.
Thank you, Akshat.
Thank you so much,
Before
sir.
we wrap up, if you want to type any feedback that will help us to make programs better, please use the chat. We'll keep it open for another minute or two. But thank you, and we'll see you at the next session.
Thank you.